Hey guys, Spencer here. Today I'm going to be going over how to utilize Python for discounted cash flow analysis. The big reason why I wanted to get into this is because as I was talking with a few of my friends, many of them were saying that just doing evaluations on companies took so much time because most of the time was requiring data entries and going back and forth to check various data sources for specific pieces of information to plug into your overall model. Now, using Python or some other computer science type of a language can definitely help speed up this process. Once you get all of your equations in place, you can just easily run it, plug in like a public name ticker, and all of your calculations will be calculated. But the entire fixed cost will be quite substantial. There's a lot of values that you might need to take into consideration and model variations, but this is sort of an introduction on how to get started with that, and it'll make your job a little bit easier. And if you haven't already, make sure you hit that like button and subscribe, turn on your notifications, because I do similar content to this and so much more. So I wrote together a Jupyter notebook on how to apply the discounted cash flow model for any type of firm that you would want to evaluate on your own. I essentially just combined a bunch of equations, and these equations came from a textbook, a finance textbook, and the links are in the description. But I'll be going through on how to utilize each and individual component for the DCF to come to a specific value of a company, which price you want to go in, or if the company right now is too expensive and maybe you should not go in. So in this case, I'll be doing the discount cash flow to the firm. There are two ways of DCF, which is to firm or to equity, but in this case, I'll be doing to the firm. And what I mean by to firm, you're evaluating the entire business as a whole instead of just the equity portion. And throughout the notebook, I'll have equations here and here for you to follow along, and what type of equations I'll be utilizing and how I came to achieve such, results, or some of these parameters and what type of values those parameters are. So first things first, in the previous video, I created a finance scraper that scrapes free financial data from financialmodelingprep.com. I'm not sponsored. I just think that this is a great use of this free financial data. So if you haven't checked out on how to scrape your financial data, make sure you do check that out. And that's just how I just get all of my data from. I'll be doing the valuation on Domino's Pizza, and the ticker is DPZ. You're welcome to check that out, but that's just what the ticker is for that. So let's run this, and here I am essentially calling my built-in functions to get my data sets together. This is the IM is the industry multiples. This is coming from at NYU's multiple calculations. They essentially just did it all for you, and I'll be explaining this further down the road on how or what type of values I will be using. So over here, this is your key. That key is meant to be secret, still related to that previous video. Got the full financial statement. This is my income statement that I loaded in. This is all the full financial statement and the income statement, and the balance sheet and the cash flow statements are all coming from the same source, which is the financial modeling prep. So to load this all in, and I'll be essentially nitpicking specific values from each of these statements to do with whatever I want to do. So assuming that these values are correct, which I assume that they are, I will be utilizing each and every one of these, well, not every, but some small pockets of data here and there to generate my overall model. Cool. So this is the equation to calculate the free cash flow of the firm. I essentially did a TTM, or 12 trailing months, on my calculation to get this value, the free cash flow of the firm. So I got my earnings before interest and taxes. You multiply that by marginal tax rate, which I assumed to be 21% due to that new law that President or former President Trump has initiated for 21% on all corporations. Put that in here, and then subtract out the capital expenditures, and then add the depreciation, subtract your change in working capital. And the 0 and the 4 is just an index, so it's getting the 4 most recent values or the 4 most recent quarters. I'm just summing them all up. Note that when I'm extracting all my information, they're all in quarterly information or statements. And the reason why I did this is because I want the most recent information possible to get the more accurate predictions or evaluations that I'm going to get. So let's run this free cash flow of the firm, and this is $293 million related to the free cash flow firm, and most recent is the most recent free cash flow firm currently. That's what it is. So further down the road, within the entire DCF, we're going to have to calculate the cost of equity and the cost of debt. And this is going to go into how we are going to calculate our weighted average cost of capital. So for the calculate of the cost of equity, I've also done another video on how to get your specific expected discounted rate. And that was just doing a CAPM. And there's another description, well, it should be in the description as well, on how I generated all this, but there's some highlighted points on where what values are most important. But essentially right here, the coefficient is 0.46 for Domino's Pizza. That is your beta term. And note that the R squared term is like 6%, which is really bad. Standard error 24%, that's also really bad. And the p-value is not really that much significant. You want this to be less than 0.05. But for the evaluation's sake, we will continue on with this metric, utilizing the coefficient with the assumption that our evaluation might not be totally correct. And that's just what life is. So using these terms that I calculated, the expected return, I will utilize the beta term over here, just utilizing the CAPM formula, and I will be replacing the riskless rate, which is essentially just like a T rate. I just used a 10-year rate, which was like 0.0089 or 0.89%. You add your beta, multiply that by your implied risk premium. So the implied risk premium, I essentially just got it from a really noteworthy professor at NYU, and I just essentially just scraped that information, just extracted the implied risk premium for the United States, and I just put that in, and I got my cost of equity here, which is really, really low, like 1.1%. Now, next, calculate your cost of debt. Very similar way. I just have a formula. You got your risk-free rate, you add in your default spread, and then you multiply that by your tax rate, well, net it out. And so in this case, I looked it up on what Domino's Pizza's bond rating was. I saw that it had a rating of like a B+. The S&P or Standard & Poor's gave it a B+, and I was cross-referencing this with NYU's default ratings on how to impose a probability of default on the company going under, and they gave it like a 3.51%. Note that this might be different from whatever other metrics you may be utilizing. Some people have different probabilities of a company defaulting, but I just wanted to standardize everything. So this was what it was for a B+ rating, and you add your spread, essentially your probability of default. You add that to your riskless rate, which was, again, I'm using the 10-year, the 0.89%, and that's equal to 4.4. Add 4.4 to your tax rate. You multiply this by your tax rate, and that was this value, 3.476%. So that is your cost of debt. Next, got your cost of capital. We got the equity. All right. So essentially, the weighted average cost of capital is your cost of debt, multiply that by your weight of your debt. So how much debt, what percentage of your debt is related to your entire company. You add that to your cost of equity. You multiply that by its corresponding weight as well. And that is essentially your weighted average cost of capital. So these are my equity weights and the debt weights. So the entire company has like 20% debt and roughly 80% of the equity. And this is our weighted average cost of capital. So this is 1.626% over here. That's your weighted average cost of capital. So we will be utilizing this value as essentially our discount rate for our first 5 years, which we will be discounting from. And this will become more clear once everything is like sort of drawn out. I'm just essentially just computing each component and bringing all the components together. So next part we want to do is to calculate the growth rate. So this is the rate at which your cash flows will grow exponentially, not exponentially, but over time. And there is some ways via the textbook that I was looking at. First, you want to calculate your reinvestment rate. That is essentially, you got your capital expenditures, you subtract your depreciation, you add in your working capital, and you divide that by your earnings after tax. So I did that. Calculate your return on capital just using that equation. I essentially just got all these, data points from the cash flow statements and the net income statements, way above there. Makes everything so much easier. And this is my expected growth rate. So I multiplied my reinvestment rate, multiply that by your return on capital, and this is your expected growth for the foreseeable future. And then you have your reinvestment and stable growth. I'll be explaining this a little bit more in depth, but this is for your in perpetuity formula for after you discounted all your cash flows and assuming that your given company is going to continue on into infinity to the end of time, right? That is your expected reinvestment value for your stable growth. Cool. And then next, we want to calculate the expected free cash flow to firm. So this is the values that I'll be using after the my present value of my cash flow. So this is still related to the Gordon's model on calculating the terminal value. So I just essentially just recalculated the cost of equity and the cost of debt. So assuming that in time, the beta term, right, whatever your beta was, ours was previously 0.46, but assuming over time it's going to go toward the value of 1, which is the market value of the beta. And that's just like an assumption that you would do when the company just exists throughout the entirety of time, quote unquote. So that's what this was. I still use the 10-year rate. You can play around with the rates on, if there's like a 100-year rate, you can go for that as well. I still use the same cost of debt, assuming that the bond rating is still the same and it won't really change, what the debt structure won't really change. I will assume that their cost of debt is still the same, and so I'll be doing that over time. And I calculate my new weighted cost of capital, which is 1.47, and compare that with the other weighted cost of capital right here, 1.6. So that is the distinguishing factor between the two. You got your reinvestment rate for less of the 5 years, you got your 40%. And then we want to calculate the after-tax operating income. So this is related to coming up with the free cash flow of the firm, and we're going to be projecting that over time for the first 5 years. So just let me run this real quick, run that, and this is what it's going to be out. So it was basically a bunch of equations that I came together. I essentially, within this for loop, I have my after-tax operating income, which I calculated up here, and from here I essentially grew at that rate of, I think it was like 2.6%, expected growth of 0.027. that is my growth rate that I'll be using for, just like projecting my cash flow. So it's growing at 2.7% year in, year out, all throughout the first 5 years, which I'll be discounting the first 5 years. And I calculated my reinvestment rates earlier. I just multiplied the reinvestment rate, which I calculated up here, and multiplied that by your expected after-tax operating income, which is given in that year. So for instance, we calculated the expected after-tax operating income for the first year, which is this value over here. and I calculated the expected reinvestment. You just multiply your reinvestment percentage by your income, and that is this value over here. You net the two, so you subtract this one, your after-tax operating income, from your reinvestment, and that is your free cash flow to the firm. And you just keep on doing this. You're growing at some rate, and you're multiplying by a given reinvestment rate. So you keep on doing that until you reach the however many years into the future you want to progress your values from. And so this is my very final rate. So in 5 years time, I'm expecting the after-tax operating income to be 5.5, I think it's like 550 million, and free cash flow like 328 million. Something along those lines. That is what my values are going to be. Now, the very next step to do when we essentially discounted our cash flows for our free cash flow firm for the very first 5 years, or 10 years if you want to go 10 years into the future. But there's some caveats to that, but that's for another video. Is to calculate your terminal value. Now there's two ways, actually there's many ways, but in terms of calculating your terminal value, there's two popular ways on how to do this. So one of the ways is to derive a formula from Gordon's growth formula, where we have the cash flow from your most recent projected year. You divide that by your discount rate, subtract that from your steady growth, right? So in this case, one of the assumptions is that your discount rate, or in other words, your weighted average cost of capital, they're used interchangeably, but they're a little bit different. But in this case, we'll be using the weighted average cost of capital as the discount rate in this particular case. But one of the assumptions is that the discount rate must be greater than the steady growth. If it's not greater than the steady growth, then we're just be using a multiple. And that's what I did for like an if-then statement down here. But essentially what the terminal value is doing is that we want to essentially calculate a way to get all of the cash flows into infinity where time ceases to exist, right? And there's some really neat mathematical ways to do that, but one of the ways here was just to get your cash flow, you divide that by your discount rate. So it's subtracted from your steady growth. You're bringing all the cash flows to your present time, and that is your overall, that's the amount of cash flow you're expected to get as whenever time ceases to exist, or whenever the company goes belly up or out of here. And this is the overall formula that I went ahead and just wrote it out. The same logic applies as I did earlier when I'm calculating my free cash flow to the firm. Okay, after-tax operating income, and then your reinvestment value from your reinvestment rate and your steady rate. So there's a distinction. So the values that I use for the terminal value, I use the stable reinvestment rates and the stable growth, which I assume the stable growth to be 3%. The reason why I chose it to be 3% was because over time, historically, the overall United States economy has been growing about 3% a year, and there's of course some fluctuations year in, year out, but if you just take the average, it's very close to that value. So that is why I assume that the stable growth of the entire economy will be around 3%. Okay, so assuming that the stable growth is 3%, I calculated the stable reinvestment rate. So my new WACC, the new weighted average cost of capital, which I explained a little bit earlier, that is what my in perpetuity value is going to be for the discount rate. And I'll be dividing my growth by my new weighted average cost of capital, and that's my stable reinvestment rate, which I will use this, just multiply it by your expected cash flows, which I will do down here. But I'll explain that a little bit later. But the terminal value of your after-tax operating income is essentially your most recent right here, after-tax operating income. It's your most recent value. I just did some indexing over here. So your very first value and your latest column, you multiply this by your stable growth rate, because it'll just be growing once using the stable growth. And then, so the reason why I multiply this by just one growth is just going into year 6, and then we'll just be bringing that back. But the terminal value of the reinvestment over here, just multiply your terminal value of your after-tax operating income, multiply it by a stable reinvestment rate, and that is your terminal value of your reinvestment. Again, you just subtract your terminal value of your reinvestment by your terminal value of your after-tax operating income. And all the equations are explained over here if I was going a little too fast, or maybe I was not explaining something correctly, or that didn't really make sense. Something along those lines. But the free cash flow to firm final over here. So all of a sudden done, you just net out your terminal value after tax operating income by your terminal value of your reinvestment. You get your free cash flow to firm on your final, and then you just want to discount this 1 year because you did you forecasted everything to your 6th year, so you discounted back 1 year to get to your year 5 mark. And then that is this is where we use a different value, so it's not the new WACC, it's actually just the WACC. So this is at our 5th year over here, and we want to discount the terminal value 5 years back, or however many years that you stuck out your discount cash flow. If it's 10 years, you'd be discounted by 10, and then that would just be whatever this value is. So these two stars right here are just an exponent, but that is what is happening here, and that is your present value of your terminal value of your company. And that's the way, the Gordon's way, so to say. And this is one of the values that you absolutely need to know, just how it works in order to calculate like a terminal value. The other way was just to use a relative terminal value. So this isn't 100% a intrinsic valuation. It's like a mix between the intrinsic value and the relative valuations. But essentially what you're doing is that you are multiplying an industry multiple. In this case, I'm using the enterprise value to EBIT value. And you're multiplying this ratio by your expected free cash flow to firm. And you are bringing this back, you're discounting this back however many years, in this case 5, to calculate your terminal value. So that is all really you need to know on how to calculate the relative value. And let's run this over here, and let's note that it says that you use relative value because I did an if-then statement where the growth, if the growth over here is less than a discount rate, then obviously we can't use the Gordon's rate of calculating the terminal value. So use the terminal value, and our terminal value for Domino's Pizza is $9.65 billion. So using this terminal value, right here, I just calculated all of my present value free cash flows. So earlier I just wrote it out over here. The free cash flow, the firm values are over here. I just discounted that to the current year, which is over here, and that turned out to be $1.48 billion. Over here, this is your value of your operating assets, and you just add your terminal value to your present value free cash flows, and then you get $11 billion over here. And then the last few steps, the value of the firm, you add in all of your cash and cash equivalents to your value of your operating assets over here. So the value of the overall firm is 11.5 billion or 11.59 billion. And then, so if you want to break it down to however many dollars you would want to spend on a given company, in this case the Domino's Pizza, you'd want to spend about $294 for fair value. Now let's compare this with the Yahoo Finance, or the market, what the market thinks of Domino's Pizza. Yahoo Finance DPZ for Domino's Pizza. Over here, note that on Yahoo's Finance we had beta of 0.41, so our calculation of the beta value was very close to 0.46, so it's very close, but this is how we calculate, and that's how they calculated it. And then let's go to the current value is $389 over here. So you can be the judge on whether or not Domino's Pizza is overvalued, but according to my models, it is saying that it is really overvalued. Maybe if you bought it like a year ago, you would make a hefty return. But yeah, so that is essentially how you do the intrinsic valuations. Make sure you check out the other videos on CAPM calculations or just how to scrape financial data, and you can go ahead and play with other models that may suit your particular interest. Now, there's a lot of downsides to actually utilize the DCF model. First of all, that there is a ton of assumptions that goes into this overall model, and there's just so many parameters that could like go wrong and just upset your model. So whatever evaluation that you may come, there is definitely an error range, so to say, that is going to be associated with what other value that you might come up with. And there are ways to try and counteract this, like you just risk adjust your cash flows, but there are in general there are ways to try and do this, but in general, predicting in the future how much money a company is going to make, very, very difficult to get like 100% right. Yeah, in fact, I don't think anyone can project the cash flows 100% of the time. But this is your daily download, so to say, on how to do a DCF model. I hope that you like this video. Please make sure you like and subscribe, and it really supports this channel and further outreach to take a look at what's going on here. So without further ado, I'll leave you to your own devices, and I will see you in the next one. Thank you for watching.